Hello, welcome to Fun Stats. Today's topic is investing. We know that some people lose their money by investing. In the meantime, the others make a fortune by investing. So, what is the difference between them? What should we bear in mind to do things well? Today, we consider these questions. Today's discussion is based on Burton Malkiel's A Random Walk Down Wall Street.
Wow, I like movies handling financial industries. For example, Inside Job, The Big Short, Margin Call, and...
Hi Joanna. We have good quality movies for that genre today. The first two have won the Academy Award, by the way. Now, to avoid getting lost while random walking, let's first grasp the book's basic idea. The conclusion is simple. No one can predict exactly which financial instrument's price goes up or down in the future. So, we would be far better off just buying and holding an index fund than attempting to buy and sell individual securities. Many arguments in the book seem familiar today, but the year of the first edition publication was 1973. The book's real value comes from the fact that the theories have survived more than 48 years in such a dynamic financial world. This video introduces summaries of some discussions. For details, please refer to the book. A random walk is the theory, meaning that future steps or directions cannot be predicted, based on past history. If stock prices are totally random walk, the consequence would be that a blindfolded monkey throwing darts at the stock listings could select a portfolio that would do as well as those chosen by experts. And based on the data observed, Malkiel's conclusion is that stock prices are the random walk. Now, backward in time, let's overview the madness of crowds that repeatedly occurred in our history. The story begins with tulips.
Oh, tulip. One of the prevalent flowers today.
Though familiar today, they were a bit novel a couple of centuries ago. The tulip craze is considered to be the first recorded speculative bubble. The beginning was a botany professor brought Netherland his collection of plants, including the tulip, in 1593. Little by little, the tulip became popular due to its rareness. Merchants began to buy an extra-large stockpile to anticipate a price rise. The more expensive the bulbs became, the more people viewed them as smart investments. Thus, the price reached astronomical levels around 1637. People tried to barter their assets such as lands and jewels to obtain the tulip bulbs. After a while, the price collapsed dramatically, and most investors were ruined by the price falls. How did this happen? As is often said, people buy with greed and sell with fear. A prudent person with self-restraints regards the bubble negatively at first. Then, watching his friends and relatives making enormous profits with chagrin, the temptations to join the game become hard to resist. Lastly, getting into the game, and others follow. Meanwhile, as the prices get so high, others decide fleeing from the craze is better. Soon others follow suit. Like a snowball rolling downhill, deflation grew at an increasingly rapid pace. And panic reigned in no time. Looking back on our history, these kinds of bubbles and panics happen repeatedly. In the 18th century, the South Sea Bubble. In the 1920s, the Great Depression. In the 1980s, the Japanese stock market bubble. Around 2000, the Internet bubble. About 2007, the real estate bubble. So, what can we learn from these histories? Malkiel argues that the consistent losers in the market are those who are unable to resist being swept up in the kind of tulip bulb craze. In fact, it is not hard to make money in the market. What is hard to avoid is the alluring temptation to throw money away on short get-rich-quick speculative binges. Two major schools dominating actual practices have been technical analysis and fundamental analysis for a long time. Technical analysis is essentially interpreting stock charts. Its practitioners are called chartists. Many of them believe that the market is only 10% logical and 90% psychological. They belong to the so-called castle in the air school, and view the investment games as one of anticipating how the other players will behave. Fundamental analysts take the opposite tack, believing that the market is 90% logical and 10% psychological. They are called fundamentalists. Their focus is on intrinsic value. If it is above the market price, they will buy, because markets eventually will reflect the security's real worth. So, which argument is right? Malkiel concluded that neither is correct. First, technical analysis. What is the rationale for the charting method? Many chartists admit that they don't know why charting should work. History just has a habit of repeating itself. Second, the technical rules have been tested by using stock price data from the beginning of the 20th century. The results reveal that past movements in stock prices cannot be used to foretell future directions. Next, fundamental analysis. Many of the most significant changes affecting corporate earnings are essentially random. So, it is unpredictable when and how the market eventually reflects the company's real worth. Second, this shows the returns from the average equity mutual fund over 25 years to 2017. As a comparison, the Standard & Poor's 500 is used to represent the broad market. Simply buying and holding the stocks in a broad market index is a strategy that is very hard for professionals to beat. Again and again, yesterday's star fund has proven to be today's disaster. Fundamental analysis is no better than technical analysis. Then, what is the conclusion? It was found that the whole market value for stocks or bonds has enormously increased in the last 2 centuries. For example, if you had invested $1 in stocks in 1800 and held them, the value would be almost $28 million in 2020. It is due to the miracle of compound interest, the greatest mathematical discovery of all time, described by Albert Einstein. So, most investors would be better off in an index fund, governing the whole market, not minding which securities went up or down. Even the legendary investors, including Peter Lynch and Warren Buffett, have already admitted this.